Today, we are cutting straight to the money and diving into the future of transport, electric vehicles. Look, this isn't just some tech fad driven by the latest hype. This is an irreversible long-term trend that represents one of the biggest investment opportunities this century. We are talking about the market that accounts for 25% of all new car sales, projected to break 20 million vehicles sold globally in 2025 and double the amount of sales by 2030. It's accelerated because of two big reasons: new technology and a global green energy push. Think about it. Cars and trucks create a huge amount of the world's pollution. The switch to EVs is the main way countries and companies are cutting our dependence on gas and diesel and making everything more energy efficient. By 2035, it's estimated that over 380 million EVs will hit the roads, accounting for over 50% of global new car sales, pushing the market past $1.19 trillion. The scale of this effort is massive and remains at the center of the new green economy. Since the policy push began in 2020, governments started throwing money at the problem by providing tax breaks, cash subsidies, and infrastructure mandates. All of this, combined with the EV technology getting better fast, accelerated the rollout of electric vehicles. However, the real fuel for this boom was the dramatic drop in battery costs. Cheaper battery flipped EV prices, turning them from an exclusive toy for millionaires into an accessible vehicle for the everyday consumer. That kick-started its push into the mass market. When you look at the world map, you wouldn't just see one EV market as a whole, but three totally different stories, each presenting unique investment opportunities and risks. First up, China is the undisputed champion. They are the world's manufacturing hub and have the largest customer base. Because they can build so many cars so cheaply, Chinese-made EVs control about 70% of global production. The competition they face at home is insane, but that intensity is exactly what makes them such a formidable player as they move into the rest of the world. Second is Europe. They slowed down a little this year, with their market share stuck at around 20%, but don't count them out just yet. New EV pollution rules are kicking in, and these rules are non-negotiable. Manufacturers have to switch back to electric models, or they would face gigantic fines. This regulatory pressure is the main driver we'll be watching closely for a big European rebound. Third is the US. EV growth has been choppy, often correlated with the latest federal incentive. Despite the volatility, the US market is projected to hit 1.6 million units sold in 2025. Even though that's a lower starting point than China and Europe, the US has a massive runway for growth, especially as local manufacturing increases under programs like the Inflation Reduction Act that incentives both domestic energy production and EV purchasing. But whether you are in China, Europe, or the US, the most critical investment insights is this: the EV race is moving past simple electrification. It's no longer about battery size or how fast it can charge. It's about computing power and software. We are now entering the intelligence phase. The future winners won't just build cars. They will be the ones that turn these vehicles into an intelligent, safe, and seamlessly connected computer on wheels. Just look at the numbers. Advanced driver assistance systems or smart driving features are now in over 70% of the market. Consumers already expect these features in their EVs. The truth is, the competitive advantage, aka the real moat in the future, won't be the engine, but the code within. This new shift is separating the tech-first leaders from the old-school automakers who are desperately playing catch-up. So, who are the companies actually winning this tech race? We are diving into the 6 most critical stocks, starting with the flagship, Tesla. Tesla is much more than just a car company. It's an all-rounder tech giant with massive scale. Their ability to build cars faster and cheaper than anyone else is unparalleled. with gigafactories that are not just assembly lines, but complex machines designed for speed and cost cutting. This efficiency is the main reason why Tesla keeps its per-vehicle profit margins consistently high, with a rock-solid profitability that sets the foundation for the company to absorb the market shocks and price wars. Tesla's approach to self-driving is entirely about data, leveraging millions of cars on the road to teach its software. The real value of full self-driving, otherwise known as FSD, isn't just a better driving experience. It's the potential for recurring revenue from the software subscriptions and, eventually, a fleet of robotaxis. The successful, widespread rollout of FSD version 14 and beyond is the single most important short-term catalyst for the entire company. If they truly prove level 4 autonomy in the real world, their stock valuation will re-rate dramatically. This is their ultimate technology dividend. Tesla faces two major risks: its valuation and the competition. The stock always seems expensive because investors are already factoring in massive future growth from FSD and energy. If FSD development hits the brakes or runs into regulatory walls, the stock could suffer a sharp correction. Competition is also fierce, with cheap Chinese rivals forcing Tesla to cut prices, which squeezes those valuable profit margins. Tesla is a core, long-term holding for any EV investors. You are betting on the successful delivery of FSD and their continued global manufacturing dominance. Just be ready to tolerate high volatility because of the stock's aggressive nature. Now, if Tesla symbolizes the Silicon Valley software approach, BYD symbolizes the ultimate industrial hardware approach. They are dominating the high-growth, cost-sensitive Chinese market and rapidly expanding globally. BYD is unique because it controls nearly every single component in the car. They design and manufacture their own batteries, their own semiconductors, and even their own electric models. This vertical integration gives them an unmatched cost advantages globally. They can aggressively cut prices to gain market share while still making a profit, a feat their rivals simply cannot match. The Blade battery is a major differentiator. Its unique design is safer, more space efficient, and allows for higher energy density. This technological control over the core EV component gives BYD complete flexibility over production and design, insulating them from the external supply chain disruptions that hurt other manufacturers. BYD is rapidly becoming a global export leader. They are not just selling in China. They are attacking markets in Southeast Asia, Europe, and Latin America with highly competitive, cost-effective models. This aggressive global push makes them a key beneficiary of the worldwide EV adoption curve. BYD is a core, long-term holding for global EV exposure. Investors here are betting on their cost advantage to win a massive market price war and their incredible scale to transition successfully into the intelligence phase. Their recent multi-billion-dollar financing to expand capacity underscores their commitment to further global dominance. Alright, now we'll move on to the Growth Escorts. First up, Li Auto focuses almost exclusively on extended-range electric vehicles, or EREVs. These are the cars that have a small gas engine to charge the battery, which eliminates range anxiety entirely. This has made them the default choice for premium, tech-forward families in China who need reliability for long road trips but want the EV experience for daily commutes. This unique approach has allowed Li Auto to achieve consistent positive profit margins and a strong cash flow, a massive difference from their pure EV startup competitors. Li Auto isn't trying to sell sports cars or city commuters. They focus solely on large, luxury, six-seaters family SUVs. This laser focus allows them to optimize production, marketing, and the in-car user experience, specifically for the family demographic, saving them money and building brand loyalty. Their reliance on EREVs exposes them to a long-term regulatory risk, as governments will eventually favor pure battery electric vehicles. Also, Competition from traditional automakers launching EVs could start to erode their niche. However, their current financial stability provides a crucial buffer against these threats. This is a relatively lower risk growth position for investors due to their established and consistent profitability. Next, let's look at the NIO, which is the embodiment of the high-end luxury Chinese EV experience. But their primary focus is on building an entire lifestyle ecosystem, not just the selling cars. NIO's unique value proposition is the battery as the service model, or BaaS. Here's how it works. Customers buy the car but rent the battery, which can be swapped out in minutes at dedicated power swap stations. This model immediately lowers the purchase price of the vehicle, get rid of the battery degradation concerns, and most importantly, creates a high-margin recurring revenue stream. They are building an entire premium community around the brand, including the exclusive NIO houses and community services. NIO is heavily invested in its own self-driving technology, aiming for a system that can compete with Tesla's FSD in complexity and usability. However, the BaaS ecosystem, which requires massive spending on infrastructure, is the main reason why NIO has struggled to achieve consistent profitability. They are spending heavily to build this moat for the future. The extremely high cost of building and maintaining thousands of power swap stations is a constant drain on capital. Their financial debt ratio is high, and they remain reliant on large-scale financing to sustain operations. This is a high-cost, aggressive business model. For investors, NIO is a high-risk, high-reward bet on the successful execution of the recurring software, and the service revenue will eventually outweigh the massive infrastructure costs. Finally, we have Xiaopeng. They openly consider themselves as a software company first, using the car as merely a platform. Xiaopeng's competitive advantage rests almost entirely on its advanced proprietary software stack, specifically its navigation-guided pilot system. This system is known for its high capability in complex urban driving scenarios, directly challenging the leadership of Tesla's FSD in the Chinese market. They view the software as the main product and the cars as simply the hardware platform. Xiaopeng is aggressively working to monetize this technological lead through subscription services and feature unlocking. Their goal is to generate recurring, high-margin revenue from software sales, similar to Tesla's long-term goal. This is where their valuation growth will ultimately come from. The company operates on very low margins, which signals intense pressure from competitors. Like NIO, Xiaopeng's high cash burn and reliance on financing mean their operational efficiency is low. They have to prove that their technology lead can translate into sustained sales volume and, crucially, positive cash flow before they run into major liquidity issues. This means that Xiaopeng is a pure tech bet. Investors are wagering that their deep focus on intelligent driving software will make them an indispensable partner or a market leader in autonomy, justifying their current financial instability. And wrapping up our 6 contenders is Xiaomi. Xiaomi's entry into the EV market is perhaps the most exciting and disruptive signal in the entire industry. They are a global consumer electronics and software giant with deep pocket, master-level supply chain management, and a massive loyal user base. They are not starting from the scratch. They are leveraging existing expertise in software, user experience, and the global component sourcing. Their core advantage is integrating the vehicle seamlessly into their user digital life. Your phone, your smart home, and your car will all speak the same language. The mass delivery of the Xiaomi SU7 sedan serves as the immediate market test. The company is betting on its ability to rapidly move from the concept to mass production and to deliver a highly competitive, technologically advanced vehicle at a compelling price point. Their manufacturing ramp-up will be significantly faster than the typical startups because they already understand industrial scale. The transition from consumer electronics to complex automotive manufacturing is fraught with difficulties and regulatory hurdles. Their success hinges entirely on execution. Investing in Xiaomi is a high-risk, high-potential scenario play. You'll be betting on a tech titan disrupting traditional manufacturing, rapidly achieve scale, and dominating the vehicle as a digital device concept. So, we've met the players, and the diversity of risks and rewards here shows that this is not a market you can invest in blindly. Playing this complex, multi-phase transition requires a disciplined strategy. We are going to build a resilient portfolio using 3 distinct layers. Best described using the analogy of my favorite meal: steak, fries, and some spice. The foundation of your EV portfolio should be the flagship strategy. This is your slab of steak, the main course, anchored by Tesla and BYD. These stocks offer stability and a broad exposure to overall market growth. Flagship stocks must have high entry barriers. This means massive manufacturing scale, technological dominance, or overwhelming brand and pricing power. Critically, they must demonstrate robust and consistent per-vehicle profitability. Tesla and BYD fit this criteria perfectly. Since Tesla provides an unparalleled lead in AI and software innovation, backed by $42 billion in cash reserves, alongside BYD, which offers scale and cost leadership, dominating the mass market with the 22% global share. The combined position is designed for steady value appreciation, capturing the majority of the market expansion while minimizing long-term operational risk. You are positioning for endurance and scale. When industry consolidation occurs, these flagships will be the ones dictating pricing and acquiring smaller rivals. Next are the Growth Escorts, your side of fries, which are the high potential growth opportunities in Xiaomi and Li Auto. They are similar, often specialized companies focused on the technological niche, market segment, or unique service model. Growth Escorts are selected for their ability to capture explosive, complementary market segments. Xiaomi's tech ecosystem integration and Li Auto's profitable EREV niche are perfect examples. Their potential returns are explosive, but their risks is commensurately high. We use them as scenario-driven, complementary stocks to capture technology dividends, where the flagships might move too slowly or fail to innovate. This layer is all about aggressive growth and asymmetric return potential. If one of these growth stocks hits a major home run, for instance, full autonomous driving approval, they can provide exponential returns the larger flagships simply cannot match. Finally, the dynamic timing adjustment strategy serves as the salt and pepper to spice up your plate. This is the flexible position management where you can fine-tune your positions based on market events and manage risk. In the short term, you must be a keen observer of quarterly events, closely track delivery catalysts, major regulatory progress, or financing moves. If actual performance exceeds expectations on these specific events, that is your cue to optimistically increase the allocation of growth stocks or your fries to amplify short-term returns. As for long-term risk management, you must set clear take-profit and stop-loss mechanisms. A crucial trigger is tied to profitability. If the per-vehicle gross profit margin declines by over 5% quarter over quarter, that is the signal to reduce holdings and preserve capital. Conversely, if a startup's cash flow turns definitively positive for the first time, that is the stronger trigger to increase investment. To wrap it up, the progressive logic from the stable core to the aggressive growth potential and finally to dynamic adjustments is what ultimately forges a resilient portfolio capable of navigating the EV transition. We've covered a lot of ground today, but the key is this: the competitive EV landscape has definitively moved past the battery size and hardware, and the future winners are in the intelligence phase, focused on turning the vehicle into an intelligent, connected computer. Investing wisely in the EV market will belong to those who can navigate this complexity and anticipate disruption. Hopefully, with this guide, that person can be you. If you found this video helpful, do let us know in the comments below. Our team of analysts work hard to simplify this complex market, and your words of encouragement go a long way. If you'd like to read the comprehensive article and get access to our real-time stock scores, check out the link in the description. As always, remember to hit that like button, subscribe to TradingKey, and stay tuned for more market insights. Thanks for watching. We will see you in the next one.